Hello there and welcome to the third part of the course. This one is all about the template that I use, and I will go through all of the 4 sheets that you see one by one to explain why I have built everything the way it is built and what is basically the fundamental rationale behind them. Now, if you are not one of those who will find this interesting and you just want to have the template without instructions on how to use it, I'll leave a link in the description. Feel free to just download it and, well, you can make any adjustments on your own. However, if you want to understand the fundamentals behind it, then I guess that you'll have to stick with me for the entire video. Now, there are 4 sheets, as I mentioned. The 4th one, even though it is, well, here it's actually the one that I used to take notes. So if you've seen the videos before, you know that I took some notes while going through the annual report. So I'm just using this sheet as one to just keep my notes. We're going to start with the input data, and of course anyone can fill the data. The goal of this template is not to have it as complex as possible, but to have it as simple as possible, yet to provide sufficient insights into the company. On the left side, this is more related to the operations of the business and profitability. We're going to take a look at this segment, for example, first, what that means. Then we're going to move to the second segment, see what that means. And the gray cells are the ones that I'll be filling. So everything that's not colored in gray, we're going to ignore that as, there are formulas that will automatically calculate what needs to be calculated. The right part is all about the balance sheet. So there are certain numbers that we will extract there. And then down here, we have some information that are not really financial in terms of not derived from the financial statements, but still relevant for our valuation. So that is the first sheet. In the second one, as you can see, a lot of data will be pre-filled. However, we need to set certain assumptions about the future. So we will see what these 3 rows actually represent, as well as the one down here for the value of equity options. And I have hidden here this section for valuation, as I would prefer to not know what the value of the company is, so I'm not biased to tweak some assumptions. So only when I'm done with the entire exercise, only then would I know whether, based on my assumptions, the company is fairly valued, undervalued, or overvalued. And I encourage you to do the same, because if you are biased and you really want some company to appear undervalued, you might just play around with your assumptions. And lastly, we will take a look at the weighted average cost of capital. As you can see, there are a couple of fields that we will fill, but we will get there in a bit. So the first part, and let's start with the income statement with the left portion of this sheet. Those are information that you already know where to find. They're available in the annual report. The first segment really shows the profitability, and it goes to the gross profit, which only shows the pricing power that the company has. The difference between the revenue and gross profit is the cost of the product. So for example, if we take a look at Nike, right, let's take a look at the template and let's start filling it little by little, right? So 2022, 46 billion 710 million, right? So all of these numbers are in millions. So I'll fill everything in the template, and I usually do that in millions. The year before, we had 44,538. The year before, 37,403, right? So then there we have the revenue. And I will take a look at the report the year before to fill in the data for 19 and 18, right? So if we take a look at the gross profit, 21,479, 19,962, and 16,241. So we can already see, and we already saw that while going through the annual report, that the gross margin actually did improve for Nike over the last couple of years. And here I have a couple of expenses that you're most likely to encounter when going through the annual report. So one is general and administrative. The other one is marketing and sales and research and development. And I left a couple of placeholders in case there are some other operating expenses that you notice that are there every single year. Now, I specifically mention every single year because you might have restructuring expense. That is something that happens not that often. Maybe a company will have it, for example, in 2020 and 2021 because of COVID. but not in 2022, 2023, 4, and so on in the future. And it's important to have that in mind because this template, at least this part, will help us understand how the company performed in the last 5 years. And we can use part of those information, part to forecast the future of the company. So as you can see, it only goes down to the operating income. And the reason why it goes to there is everything that I've mentioned here is something that the management can control, right? So they can control or they can impact, for example, the pricing in terms of their products. So they have impact on the revenue. They have power to negotiate and to have lower cost of their products, right? For example, here the demand creation expense, that is actually what we saw in the previous video, is actually the marketing and sales expense. So I'm going to add those numbers, 3,850, so that's 3 billion, 3,114 and 3,592. They have the power to reduce that. If they want, they can spend less on marketing and sales, right? And this last part, operating overhead, I'm going to add that as G&A. So 10,954, 9,911 and 9,534. So I can already see how this looks from a complete operating margin point of view. So if I take all the operating expenses that the company has, it did improve over time, but of course 2020 is a year with COVID. The sales were already quite down, so we need to still, let's plug the numbers for the 2 years before that, and then maybe we can take a look at some of this and draw some conclusions. Although this video is really just to explain how the template works. In the next video, we will really dive into the data and try to find some more insights through it. So 39,117, 397. And you see that once you fill all the numbers, this is the average growth of the revenue over the period. So this actually 4 years, right? Because we have 18 to 19, 19 to 20, 20 to 2021, and then to 2022. So the revenue growth was about 6%. This is useful as you already know that if a company grows at around 6%, you cannot expect that now it suddenly grows at 10% organically. So let's take a look at these other costs, right? So marketing and sales, that was pretty much the demand creation. We have 3,753, 3,577, and we have the G&A 8,949, 7,934. So I think, oh yeah, of course, and the gross profit I have not filled yet, 17,474 and 15,956. So here we can see some trend when it comes to the gross margin. We can see the operating margin actually, even though here it looked as if there was a huge improvement, in the last 5 years it was 2%. This is one of the inputs for the model for forecasting the future free cash flow. We'll get to that in a bit, but it's quite clear that we cannot forecast margin of 20%, for example. This is a mature company and there are limited improvements that they can make. In fact, you see that the general and administrative expenses actually grew faster than the revenue. So this is, for example, one segment that they need to find improvements, as this is not something that is normally the case. Marketing and sales, that's actually quite good. Their spending as percentage of revenue isn't growing as fast, right? So this is, for Nike, actually, this is the only part that we need to fill in this part, right? Now let's take a look at the balance sheet. And I'd like to first cover why I have outlined these lines. So let's take a look at the annual report and let's take a look at the balance sheet, right? So in the income statement, we took only the numbers that the management can control. So we didn't take, for example, interest. The interest rate is not something that they can impact, right? We didn't take taxes as well. Again, that's not something that they have any control over, right? The tax rate is set by the governments in the different countries. So let's take a look at the statement and ask ourselves, start with the assets, right? If a company didn't have any of these, for example, let's say that the company didn't have this cash, would it be able to create the same results that they had in the last year or throughout these 5 years? In theory, yes, right? The cash is not what they were selling. They're selling inventory. The cash is, it's important that they have certain balance, right, to keep the operations going. But if they had half of this cash, it's still fine, right? This is not an asset that is involved in the regular operations of the business. What about short-term investments? Absolutely not. So if they have an excess cash, they can invest that in certain short-term investments and get return in probably a couple of percentages, and that's it. So if they decided tomorrow to sell all of this, so the 4.4 billion, it has zero impact on the products that they're going to sell in the future, the quantity of the products, the pricing. This is an asset that they have, but it has nothing to do with the operations. What about accounts receivable? Well, that is necessary for their operations. What about inventories? Exactly the same case. Prepaid expenses, exactly the same case. What about property, plant, and equipment? Well, they need that. If we sell all of that, they don't have offices. That's not the case, right? It's not what we need. They don't have stores. It's clear that not having those assets will contribute to, well, it would lead to them not being able to have the same results as they had. Operating, lease, right-of-use assets, so those are the stores that they have leased, and the same case. So everything that we see down here is necessary for them to run the business, except for, we could argue, deferred taxes. Deferred taxes are basically, in this case, we probably have them on the liability side as well. You see, I'll mark them here. The net of both is positive. We actually saw that in the previous video. They will have benefit from that in the future as they will be paying less taxes. But the question is, when will that happen? It could be a little bit every next year. So only because there's a deferred tax asset on the balance sheet doesn't mean that the value of that asset is worth exactly what they have on the balance sheet, because it's not being discounted. If, for example, it is, I think it was around 1.7 billion for Nike. If they have a deferred tax asset for 1.7 billion, but this is coming 5-10 years in the future, it's not worth the same amount today. So we will see that in the template. I do not take all of it. Now, what about the liabilities? Well, this part is actually more related to how the company is being financed, right? So, but let's go through the same exercise, right? What if they pay the entire current portion of the long-term debt? It has no impact on these few lines of the income statement that we saw. Same goes for notes payable, although this is a ridiculously low amount, like 10 million. Well, accounts payable, that is needed. Current portion, we don't need that, right? It can be paid down. Accrued liabilities, likely that is related to their operations. Income tax, also again related to their operations. Long-term debt, well, they can pay that. Lease liabilities, they could own the assets instead of. So actually everything that's down here is kind of course now funding related and of course the total shareholder equity. So why do I have these fields here? If you take a look at this, these are actually the ones that have been highlighted, right? So we have cash and cash equivalents, 8,574, so about 8 billion. Short-term investments, that's this line, so there is no marketable securities. I could compress all of this information into one line, but I left them like this, so it's more descriptive for you in case you're using this template, right? So short-term investments, 4.4 billion. Long-term investments, they don't have anything, so I'll leave that at 0. Deferred tax assets, we can probably search for net deferred tax. We'll probably get something there. There it is, 1.665. So what I'm going to do is I'm going to take 1.665, but I'm going to divide it by 2. So basically what I'm in this case adding is, although you have 1.7 billion in deferred tax asset, I'm going to value that at half of that. So it was page 61. I'll go back to the balance sheet and let's add the rest of the numbers. Now there's here another row that I just added, other non-operating assets. So if you are looking at the balance sheet and you just notice that there's something else that hasn't been mentioned here, but it doesn't really contribute to the profitability of the company, you can just add it here. In the case of Nike, there's no such thing, so I'll leave it as is. Now let's take a look at the second part. Short-term debt or borrowings, well, or the current portion of the long-term debt, 510. I'll also take the notes payable. Current portion of the operating lease liabilities, that's next, 420. Long-term debt, 8.9 billion. Operating lease liabilities, right, 2,777. Minority interest, that wasn't the case. It doesn't exist here. If you find a company that has that, feel free to add that. And lastly, there's a book value or the equity, that's the total shareholder equity, 15.281 billion. Now, take a look at the next part. In the last 12 months, Nike had revenue of a little bit higher than 46 billion. And the capital that was actually in use that contributed to achieving this number of revenue was about 14 billion. So the sales to capital ratio, or the revenue compared to the invested capital in use, is 3.32. So if, for example, I expect the revenue to double some point in the future, then I should expect that the invested capital also doubles, right? That's the only thing that's fair. We cannot expect that the revenue doubles without, for example, doubling the number of stores that they have, or the number of accounts receivable and payable and everything that's related to the business. So we're going to use this as something a little bit in the future, probably in the next video when we're looking into the valuation and setting these assumptions about the future. And there will be some exceptional cases where this might be negative, or it might be just unreasonably low or high. Normally, depending on the industry, it will be between certain numbers. So I want to cover that in the next video as well. Probably, I'd say between 0.5 and 5, but again, depends on the industry. So we're going to take a look into that as well. This video is only about really understanding how this whole Excel file works and what are the information that are needed and how they all tie. So this is really to understand the revenue generation based on the capital that they've had so far. Now, the second part is quite simple, right? So let's take a look at Nike share price. It is 97.02. 97.02. The number of shares that they have, we can find that at the very beginning. We also covered that in the video on how to read a 10K, right? Here we can see the number of shares outstanding as of these are the latest numbers, so as of July 8. So let's add that in. Since we're filling everything in millions, so this should also be 1568, so that is the number in millions, 555905. The risk-free rate, the way you can find it is if you just search for example, for US Treasury 10-year bond or yield. So, for example, in CNBC, it should be probably around let's round it to 3.7%. And I will also cover later why this is important. But here's a simple check. Check if the market cap of the company is 152.18 billion. So let's take a look at Nike. If that is the case, yes, 152.18 billion. That's exactly what we have. This is important because the number of shares outstanding that we have disclosed based on the latest annual or quarterly report might not be the latest number, as there might have been some event in the meantime that has happened. So just make sure that you have the right number here. Otherwise, you can do it the other way around. If you fill the market cap, if you fill the current share price, and then the number of shares would be, of course, the division between the two. So at this moment, we have everything that's historical. We can do some analysis here. We can see how the G&A as percentage of revenue changed over time. Now we know that it grew faster than the revenue. So now it's naturally greater percentage, higher percentage. Now let's move to the second sheet, valuation, right? So the base here is where the company is at the moment. So the last 12 months, what actually happened. This is the revenue that they earned. This was their margin. Again, this is information that comes from this sheet. Now the question is what will happen in the future? And at this stage, we don't have enough information for that. We do know that most likely this 6.4% will be the ceiling. So hypothetically, let's add 2%. I'm just adding this to fill the template, but of course, we need to really dive deeper into the numbers to see what makes sense. So I'll just add here 2%, just so we have numbers. And I'll leave the, let's say, the margin at 12%. Again, it's not rational at the moment. It's purely to have numbers to review the template and to see how it works. Now, if this is what happens, right, in the future, this is the growth of the revenue over time. This is the margin. And at the moment, again, we've only taken the operating expenses. So we haven't taken debt, we haven't taken interest on that, and we have not taken taxes. So let's take taxes. This is one of the inputs here, 25%. That is most often in the future, the companies move towards that percentage. So I've used here 25%. However, if at any point you feel that a different percentage is more reasonable, feel free to change that assumption. So if this is what happens, right, this would be the revenue. This is the operating margin that they have, which calculates the operating income. Then we pay taxes, right? So this is the 25%. So this is the operating income, but after tax. And here we have reinvestment. So what does that mean? In the past, we know this number 3.32. So for every $3 increase in revenue, we should expect $1 increase in capital. So if we just add here, for example, 3, this reinvestment will automatically pop. So basically what happens here is this a simple formula. Calculate the difference of what we expect the revenue to grow and divide it with the ratio. So we are kind of expecting this, let's say that it is exactly the same over time. We're expecting this ratio to continue being 3.32 throughout time in the future. Hence, based on that, we're calculating what is the future reinvestment that we expect the company to make in, whether that's increasing the number of stores or accounts receivable or inventory over time, and so on. So you'll notice that, for example, if I expect the company to grow 10%, the reinvestment will no longer be 282, it would be 1408. Again, these are all numbers in millions, so the 10% revenue growth, this means reinvestment of 1.4 billion. So far this is, I'd say, fairly simple to fill in, but we do need a lot of knowledge to understand, of course, is this reasonable, is this reasonable, and is this reasonable? So there are 3 levers, and using these levers, you can always make a case that a certain company is undervalued or overvalued. And that's why I want to keep this part completely closed for now. I'm going to open it at the end just so you can see, of course, how the whole template works. But when I fill the template with the assumptions that I believe will are more likely to happen, or at least are have the highest probability to happen, then I don't look at this until the very end. And this discount rate, of course, this will come when we move to the next sheet. However, if you are not a big fan of weighted average cost of capital and you just want to skip all of that, and I don't know, maybe you want to use a discount rate of 10%, just use 10% and fill it until the very end, and there it is. So the model will pick up everything and you don't have to worry about weighted average cost of capital. I do think that it's relevant. I do use it. I will explain the rationale behind it as we go along, but of course, you don't have to do that. The idea here, of course, with the discount rate is taking the numbers above. So for example, 6 million of operating income, then we pay taxes, we have 4.6 billion, then we do the necessary reinvestment and we're left with 3.2 billion. But this 3.2 billion is 1 year down the line. So today it's not worth as much, hence we discount that. Same goes, for example, if we take a look at year 10, we're expecting close to 5.2 billion in free cash flow, but today, as you can see, discounted by 10%, it's worth a little bit below 2 billion. And I'm going to, of course, reverse the formula. So I do want to use the weighted average cost of capital. So when we do this, so assuming that's 10%, what we get here is the outcome. So the present value, as you can see, that is the present value of the cash flow that we expect the company to generate. This is the terminal value based on, of course, the generation of the cash at year 10 and what we expect to happen in the future. And this, after discounting that, we get the value of the business based on all the assets in use, all the operations. And at this moment, we're not considering how much cash they have, how much debt they have. It doesn't matter. It's all about the profitability, excluding all those segments, right? But we cannot ignore the cash and all these other, as you can see, non-operating assets, right? So we know the cash. And if you take a look at the formula, all of these other non-operating assets are basically these down here. So this is the assets that they have, but have no impact on the operations of the business. Hence, we just add them here. We subtract the debt, we subtract the interest, and there's this last part that I don't see mentioned very often, but I think it's very relevant. So what is the value of equity options? Let's take a look at Nike, right? If I take a look at all the way to the end, let's take a look. There is one segment related solely to the options. We know that the share-based compensation, for example, is part of the income statement, and if you take a look at the cash flow statement, it's added back. Well, I don't do that. I treat it just as a cash expense, and it's a much easier way to do that. But there are stock options that have been granted to whether it's the employees or the management, that give them the option to buy a share of Nike at a cheaper price than the current market price. So if you take a look at this here, as of 31st of May, there were 68 million shares that they could have bought at a price of 88 on average, right? So this is the average option price, $88. Now the share price, as we saw, was 97. So in theory, they could have bought the share at 88 and they could have sold it 97. But if you're a shareholder of the company, you get the 88. So the value of the company is being diluted because someone else enters as a shareholder at a lower price than what's fair based on the market terms. So how can we use this value, right? It's quite clear that, for example, imagine that we go to the extreme and someone gets free shares, then you as a shareholder, we have a lower percentage. This is not going to exactly that extreme because there's still some cash flowing into the business, but they have the option to use this in the next close to 6 years. So they don't have to use it this year. So there's this website, and I'm going to leave this also in the description. It is Black-Scholes calculator that takes a couple of parameters and it calculates how much each share is actually worth. So first, what we need is the spot price, or the spot price is basically the share price today. We have 97.02. So let's add that here. 97.02. The strike price is the price at which or in this case, it's called the weighted average option price, and how much the employees or the management would pay if they are to exercise that. So 88.66. 88.66. How much time do they have until the expiration of the option, right? So it's 5.8 years. 5.8 years. What is the volatility? It's close to 25%, so we can round that. What is the risk-free interest rate? This is something that we already have in our sheet, right? So that is the risk-free rate, 3.7%. I hope that that you could see the numbers that I filled here as I was filling the template, but if not, then apologies for that. Here are the numbers. So 3.7%. So if we go back here, 3.7%. And of course, the dividend yield, well, you can get that just by searching, for example, Nike stock, and 1.26%. So 1.26. So what this does is it takes these parameters and it calculates that every share that's outstanding is worth close to $30. And it's not the difference between the spot price and the strike price, because they also have this time advantage as well. They don't have to pay the 88 today. They could pay it in 6 years, and who knows how high the price would be there or how low, right? I mean, it could go both ways. So the price of every single option outstanding is 29.8. And as we saw, there are 68 million options outstanding. So what we need to do is, in the Excel file, in the valuation we would add, well, we have 29.8, that is the value of every options multiplied by 68 million. So that is roughly 2 billion of just the value that will be kind of not, I wouldn't say destroyed, but just diluted because of the equity options. And if that is the case, of course, this part here, assuming that that is working perfectly, right? I'm going to reverse this now because I do want to have the formulas. I'm going to add it now, 29.8 times 68. Of course, that will reflect in the valuation. Now, the discount factor is something that we still need. Let me just add this again back. So why do I use the weighted average cost of capital? It is not that complex model, but I do understand that there's some complexity to it. The idea behind it is if somebody wants higher return, they need to take higher risk. And that is a financial concept that risk and return are correlated. Now, how do we measure risk? There are many different ways. But if you think about from a business point of view, right? For example, with the situation as is today, if Nike was sourcing the products from Russia, well, we know that it would have been high risk business and we should expect high return because there's a lot of uncertainty. If, of course, all the manufacturing was within the US, there's more certainty, hence the business would be perceived as less risky. So I take this table that's on the right side and I take it on region level, as most of the times you will be able to extract the data on regional level. This is coming from Professor Damodaran's website, and I'll definitely cover that in one of the next videos. Here are the equity risk premiums in the different countries. And I have noted here revenues, as most often you will be using revenues as a metric for risk. But for Nike, I'd say that's an exception. A lot of the risk is also in the country where the products are being manufactured. So we're going to cover this part. So we're going to fill these numbers and, of course, the two sections here, the two cells here. And once we do that, we have the weighted average cost of capital ready. So here in the notes, I have added that on page 39, we have split of revenue. So let's go there. Here's the split of the revenue, and I'm going to focus only on this top part, so North America, EMEA, Greater China. So let me add that quickly. Maybe I'll try to do it like this, so you can also see both the data and the input. So first part is North America. We could add that as US, 18,353. Then we have Europe, or we could say EMEA, right? But it's large part that is actually in Europe, so 12,479. Greater China, 7,507. And we have APAC. So I would say mostly it's in Asia Pacific, it's also in Latin America. But if you take a look at the rates between Latin America and Asia Pacific, for example, Asia, you see that there's difference in terms of the risk, and you should demand higher premiums if you invest in LATAM. Now, there is no split here. I don't know if majority is in LATAM or not. So what I'm going to do is I'll divide it into 5,955 divided by 2, and I'll do the same for LATAM. And if I do that, you'll notice that the equity risk premium that I should expect for a company that operates within these countries should be about 6%. That is the risk premium. And we have to add that on top of the risk-free rate, but also there's this beta. And we'll get to that. Now, the cost of debt is something that we also saw in one of the previous videos. It's quite easy to get. We could see it also from the long-term debt. You see, it was depending on the debt outstanding, but it was around 3%. So sometimes if you just search for example, effective interest rate, you might get a percentage fairly quickly. I'm going to add the 3%, and that is quite a good estimate, and I think it's fair for a company such as Nike. Now, what is beta? This is the last part. What is beta? If you just search for company stock beta, so Nike stock beta, you'll see that it's 1.03. So I'm going to plug it here, but I want to explain why this is the case. So let's take a look at the structure here. A risk-free rate is what we should expect from a government bond. So government is risk-free. So if we get 3.7% from something that has no risk, now that we are looking into something that is more risky, we should demand for higher returns, right? Beta indicates how risky the company is compared to the average company in the market. So this, for example, could also take the financial leverage. If we have a company that has a lot of leverage and is likely to go bankrupt, maybe it will also reflect here within the beta. Maybe not, but it could also be. Beta is a measure of volatility. So how volatile the company is, the stock is compared to the average company in the market. So 1 indicates close to average. 0.5 means that it is half as volatile, and if something is less volatile, then it's just more safe, because there's, of course, if we look at it from a risk perspective, it doesn't have that much risk that it goes up or down more compared to the market. But if we have a beta of 2, for example, and take a look at the cost of equity, it increases to 16%, while before it was 10. The higher the beta, the more volatile the share price is. That means there's more risk, because it just keeps moving in different directions, and you have to accept that. Is it perfect? Of course not. There will be companies that have, first of all, negative betas. There will be companies that will have no beta available. It's not perfect, but when the data is available, I believe it's an interesting model that exists, and it gives us something to work with that actually takes not only the risk measured through the company's share price, but also based on the region that it operates. Now, based on this, we know that we have about 12 billion in debt, and the after-tax cost of that is 2.3, and we have 152 billion based on the market cap. And based on the model, we should expect 10% for that and 2.3 for the debt. So on average, right, weighted average cost of capital, it should be 9.46. But if the beta was closer to 1, we should expect a bit of a different model, right? So this part here is assuming that the company, as time goes by, the beta moves closer to 1. So now it's 1.03. If the beta was 1, it would have been, instead of 10%, a little bit lower. So not really that much different, of course, in this case. But if it was 2, for example, you'll notice that if it moves closer, then of course this also decreases. I don't get it to exactly 1, because majority companies, there's a reason why they're more risky, and it doesn't mean that that risk will go away. It will probably get closer, but it doesn't mean that it will be fully exactly the same risk as the average company on the market. Now, for Nike, this would not be fully correct to fill in my opinion, because the revenue, it is being generated somewhere, but it doesn't mean that that's where the risk is. As we saw, a lot of the manufacturing is being done in Asia. So what I will do is I will take the revenue and I'll add all of it in addition to small China, to small Asia, because that's where actually the manufacturing risk is. So I'll add this 44.34 here as well. So now this actually represents the revenues, but also kind of the source of revenue in terms of the products. Of course, this brings, for example, let's say the total weighted average cost of capital to 10.42, while before that it was 9.46. Only because the products are being manufactured overseas and there are additional risks, I want to capture that in my model. So when that is the case, we can go back to this is normally something that you do once and then you just don't look back, because it doesn't change really that much. What will change at some point is the equity risk premium, as some regions might become more risky than others. But I will make sure to update that, and also in the next videos to explain where you can get those information. And once you have that, of course, if you click on valuation, then you'll see that, of course, based on these assumptions, this is the value of the company, including everything that we've adjusted for. Based on the number of shares, this is the value per share, and this is the current price. So if you are to buy it, then you have actually a negative return. Of course, this doesn't mean that it's correct, because we have really low assumptions. But for example, if it grows at 10% for a very long time, we have 3.5% expected return. So we can't make any conclusion yet, and so hence I'm going to reverse this and I'm going to close the valuation tab. I don't want to see that until I'm completely done with all the assumptions and I don't have any biased assumptions included in the model. So that would be all regarding this video. I hope that it wasn't too long. I know that it was quite long still, but I hope that you get some value out of it. And if you have any questions or comments, please let me know. And of course, I'll see you in the next one.